Here we are. My name is Mogens Røe. I have a small company called Rye Outsourcing Solutions, where I do these webinars and other services for asset managers and other companies that want to have part of their processes outsourced. So either I can do it or I can help find the right persons. I've been a stockbroker for 35 years before I decided to go into the world of my own little company. And in that respect, I worked a bit also on the quant side. And I'm very pleased that I got to know Constantin and TenViz and their algorithms. Constantin is the former chief cross-asset strategist for JP Morgan, a very well-known and respected institution. And also he's been working for, among others, Alliance Bernstein, that I know pretty well myself, because they also have a Danish operation actually. So Constantin, with these words, I will just leave it over to you, just reminding people that we are recording this webinar and the replay will be ready shortly after we have ended the webinar later on today. Constantin, I know you will talk a lot about your systems and your current findings, but please make your own introduction.
Thank you so much, Morgan, for the introduction. I appreciate you setting things up. And it's a good morning or good afternoon to everyone, depending on your time zone. So thank you again and welcome. We'll walk you through a few things. We'll tell you how we think about investing completely differently and what we think how AI we think will overtake investing. So with that in mind, couple housekeeping announcements. If you have a question, please do type it, and we'll try to answer it in due course. And also, if you want to be added to our email distribution list, please type your email address, and one of our colleagues will add us to your distribution. And of course, if you would like to explore something deeper, please contact either Morgan's or myself or my assistant Anastasia. She should be present as well. So with that in mind, as we have intended, we will walk you through how you view the world of investing now, what are the interesting themes, and specifically how AI helps us to see something that is likely to happen before it happens. So with that in mind, I'll be sharing a little bit of a screen to illustrate it. Before we start on the investing side, this is a vision that I had for this for the company. And I was a professional investor for many years. As Morgan has outlined, I was a cross-asset strategist at JP Morgan. And before that, I was a portfolio manager at Citigroup, Omega Advisors, and Alliance Bernstein. And my vision was always that the future is changing. Investing is changing. Outside of 99%, maybe even almost like 99.9% of investing is still any true long-term investing. I'm not talking about trading. It's still done by humans who are struggling in front of computers. We think the future is here. I don't think too many people would argue with that point, but in reality, that's a vision that we bring to our clients. So we actually make this happen. We help people not just being computer equipped, but also be totally AI enabled. And the use case, very simple. So we still think human has a long ability to see some long-term trends, typically applying some sort of fundamental views. You like your Google, you like your Microsoft, and so on. But we do help you enter those positions better for the longer term. So we combine your longer-term view with a tactical smartness or prowess. So that's an idea. So we have the team of about 16 people on our team. And what we also have is we've been around for 7 or 8 years. We work with large institutions and small institutions in the US, in Canada, in Europe, in Asia, and so on. Pretty much spanning all financial capitals of the world, helping professional, again, investors to make investments outperform the markets and provide better returns for their clients. The essence of what we do is AI. So we have layered models, but we are different from, we are not generative AI. We don't use generative AI in the classic sense. In fact, if you would ask any generative AI LLM model, it has no way of knowing where any stock or any index will be. If you ask ChatGPT, where would be S&P next week or month, it has no way of knowing. Because predictive AI can only do one thing. It very intelligently extract existing themes or thoughts within the existing body of knowledge. Within that existing body of knowledge, nobody knows where S&P will be, say, equities will be in a year or 3 months from now. It just doesn't exist. So what do? We do predictive AI. Again, not generative AI, but predictive AI, where inherently we make using AI to make statistical prediction to forecast the future. The future doesn't exist. That's why we'll never be perfect. It will never be 100%. But our goal is simple. Our goal is to out forecast a human. Again, the goal is not to be 100%, right? But the goal is to be better than a human. So that's an idea. And even more importantly, we view as a best addition to human is not to tell a human something that is obvious. Like, we wouldn't be telling you, hey, the Fed is likely to cut rates because inflation report this morning was cool, which is wonderful. We tell you something that is not obvious. And I will give you a bunch of examples today. With me so far?
Yeah.
Thank you. So I will switch to our live platform. And I'll walk you through some examples on how we actually make a prediction. So apologize for a second. I will switch back. We forecast everything and anything, and our approach is inherently holistic. So we span everything. We cover all sectors, all countries, all styles, and we cover all single name stocks, and we cover everything. So we can talk bottoms up, top down. We can talk about factors and commodities and real estate and interest rates and foreign exchange and stocks and sectors and themes. So with that in mind, I'll give you some interesting rotations, a little bit emphasizing some unexpected rotations that we see. For example, now I'm switching away from a slide deck towards our live tools, where I will turn our signal. So this is actually, I will give you an example of our existing forecast, but I will start with something simple. I'll talk about energy a little bit. So this is oil, American oil WTI, trading at NYMEX. So this is a chart, and this chart plots our signals for oil. So at this stage, we had a sell, here we have a sell, so we're still underweight oil. Our tools forecast that oil will probably go to the high 60s, low 70s. So that's existing forecast about $74. And as you can see, with some noise, that was a very accurate forecast. But that's not the most interesting part. The most interesting part was actually we had a negative sell, or we have a sell, i.e. downside column oil here on October 8th. And unfortunately, or not a coincidence, that happened 2 days after the breakout of hostilities in Israel, in Israel. Human tragedy aside, which was very disturbing, of course, what happened here, many conventional investors would have said, all right, there is a breakout, there is a calamity in the Middle East. In this situation, I should be buying crude oil as a hedge against potential flares in the Middle East. And the situation was getting worse, yet our tool said, no, the world is abundant in oil, and oil is unlikely to go up. So at this point, we were forecasting it to go lower, and it went down. So that was a good, accurate forecast at that point. As you can see back then, our forecast was about for $78, and it was achieved with some noise, some predictable noise. So that's a wonderful example, again, human tragedy aside, when tools were telling investors to do something that is not obvious. However, the world is nuanced and more complex. I will switch, finishing the conversation on energy. I will tell you, with that in mind, our tools obviously make forecast for sectors or single name stocks. For example, at this point, approximately April 8th, we had a sell on energy as equities. So we don't forcing this connection like we are bearish on oil, let's sell energy stocks. But sometimes that does happen. So remember, interestingly enough, we were bearish on crude oil at this point, yet we were buying energy stocks, and they did work pretty well. So this conventional, this example is also interesting because first of all, these signals were very accurate in their own right. So we had a buy on energy stocks in October, and as we can display the gains, it was a pretty good run, 14%. And obviously this was a good sell. We avoided this drawdown. However, even more interestingly, we had a buy on energy stocks approximately when we had a sell on crude oil. As with some noise and ups and downs, again, crude oil was remained relatively flat since this period, yet energy stocks have outperformed. So it's actually, again, one of those examples when we add value through being a little bit, so our tools, AI-powered tools, have a way of knowing the future better than humans.
So just let me ask you one question here, and also a quick answer to one who's already put in a question. And that is, we will send out the PowerPoint presentations to you all after the event, including you will also get the replay of the webinar. But what I wanted just to emphasize here, Konstantin, is how do you see which one is the oil and which one is the energy when you have these different recommendations put together in one screen?
That's right. So this is actually they plotted using different colors. So the oil in this case is gray.
Okay.
And the energy as an index, it's a US XLE index, is plotted blue.
Okay, sorry, I missed that. Thank you.
And indices are obviously energy index. XLE is on the left, blue, lefty. And obviously oil is proxied on the right. So thank you for that question, Mogens. I could have clarified myself. More interestingly, without boring you guys how it works, basically we estimate money flows coming from different asset classes here, and I will hide it here for the time being, but I will highlight it slightly later. So this is a story on energy. However, again, my point is to tell you something that is not obvious, and I will tell you that energy stocks were selling off and crude was going down. But that was not the full story in energy. For better or worse, we had a new important player re-emerging in the energy space, and it's obviously called natural gas. So natural gas, let me simplify the chart. Natural gas spiked after this profoundly disturbing the war in Ukraine, and I know that unfortunately all too well because I grew up in Ukraine and my relatives are still living in Ukraine, so I know it all too well. And here what we have is actually at this point we had a buy on crude on this is natural gas in America, and natural gas in America is more important actually for American households than gasoline. Yes, gasoline grabs all attention, but an average American household spends only $140 on gasoline. But on utilities, which are often proxied to the price of natural gas, it's a lot higher. So as it was deflating natural gas since post-war highs of 8s or 9s, it was actually very deflationary. It was favorable to the utilities that paid by households, not only in the States, but also in Europe. But at this point, we had a very accurate buy in March on natural gas. So interestingly enough, our tools figure that despite conventional assumption that crude oil and natural gas should be correlated, no, they are not always correlated. And we can understand the difference. What is behind the rise of the natural price of natural gas? This is, by the way, is American gas, so-called Henry Hub. Well, we know that electricity demand is driven increasingly now by three additional drivers. First of all, electric vehicles switching away from gasoline towards obviously electric power chargers at home and so on. Second, obviously, AI is a very power hungry, and it also generates a lot of demand for electricity, as we know. And the third one, we know we had a very mild winter both in North America and in Europe, and now we expect actually a very hot summer. And the utilities will be burning more electricity to generate electricity and cool down. Even more interestingly, the stories that we like in natural gas has a lot of global connections. For example, we see that money flows into natural gas from Japan and Korea. And that makes sense because both countries spend a lot of money. They are largest importers of LNG, and that's one of the most underappreciated stories in the world. So the rise in the price of recovery in the price of natural gas potentially would be important driver of global inflation, despite very good report this morning, which we obviously all welcome. So that's the story in energy.
Talking about today's inflationary number, aside of the number itself, what's your take on that at the moment?
Thank you for asking that question, Morgan. I appreciate it. I can reply with a conventional joke that using the Fed's favorable methodology, excluding everything, the prices were flat. Or we can say they were flat actually month over month, some noise. And the way we forecast inflation, actually, what we think about the bonds. So we actually have a technically favorable view on the bonds. We think interest rates will drop slightly lower. And that's consistent with that. Inflation has at least temporarily peaked. However, as I said before, we still expect that it will not go all the way down to 100% because the late stage cycle economic expansion, the tightness in commodities might manifest itself in higher commodities prices. So we are okay right now with inflation, but we are mindful of the potential disruption or some unexpected rotations out of from commodities. So that's a good question. I see a couple of questions.
The one we've answered already. The other one is that in your weekly newsletters that we all appreciate very much, that you no longer include a risk-off recommendation. Is there any reason for that? Is it technical reasons or just a deliberate decision not to include it? Or
yes, let me jump before I go to that. Let me just finish the conversation on the energies. There was a question from in the audience on the energy services. So we are cautious on the energy services as well. And as you can see, we had actually a very well-timed sell signal. And we are cautious on all the services as well at some point. So this is short-term caution. Longer term, we think it's a good opportunity to buy. And by the way, this is a good illustration of some questions that we hear a lot from clients. Typical question is actually, users are asking like, give us an example when it didn't work, or when you kind of like miss something. We miss things all the time. We are not perfect. Even on this, which seems like a very, very good signal, one can argue, hey, why didn't you sell it here? Why didn't you sell it here, right? Why didn't you buy it at this bottom? Why don't you buy it again here? So, but the idea is not to capture every bottom and sell every top. The idea is use a computer guidance based on money flows and use that as a preponderance of evidence of if the general midterm or even longer term is up or down. So hopefully that answers your question. So So this is actually, from one extent, you can say it's a successful forecast, but also there is a bit of humility here, right? Saying, hey, it was good, but it was never perfect, and it will never be perfect. So now answering questions from audience, which leads us to the whole new conversation on what we used to have. We used to call the module risk on, risk off, and we renamed it. We call it narrow market and wide market. So essentially, it's a diffusion indicator. It's very successful in telling people how broad the market is. It's not, and we switched simplified it away from risk on, risk off towards narrow market or broad market for two simple reasons. Because typically people associate risk on market with a mega rally, big rallies. That's not always the case. Risk on means conventionally, actually, accurately, everything is working. And unfortunately, for the last pretty much 6 or 7 or 8 months, there was still very, very few things dominating the market. We all know the Magnificent Sevens, the NVIDIAs of the world, the semiconductors, and they stole the thunder, right? So essentially, we still have equal weighted S&P, and this is equal weighted S&P. Again, there is a big difference. There is a conventional S&P and equal weighted, basically underperforming since March. So it's barely up for the year. So that's a big deal. If you're buying anything but Magnificent Seven, you will not be making much money this year. So that's a good foray into that conversation. Morgan, thank you for asking that.
That's my pleasure. There was actually also a question actually related to this, and I think I've actually asked you about it in the past as well, is that how do you get the money flow? And I know you talk about real life money flows and so on. I mean, wouldn't that require a supercomputer to handle that kind of information in the way that it looks so easy on your screen?
Thank you for that. We worked a lot how to get money flows. We found clever ways to get those estimates, and they work pretty well. So there is a lot of know-how and experience built by my team. Again, we were doing this for 8 or 9 years. We have about 15 developers and world-class data scientists working for us. And what we do is essentially we try to apply something that the other people don't. So again, this is a little bit of a proprietary deep expertise that we have developed, and that's what we apply successfully. So it's a good question. It's a very elongated, elaborate answer. So, but that's what we do for a living.
The other thing that I just wanted to focus a little bit on is actually also from a question from our audience, and that is when you have these buy and sell signals, and as you said yourself, we don't aim to hit every bottom and every top, but how do you get to when do you put a buy on or a sell on? Is this kind of technical only? Is it some kind of secret, formula that says when X and Y goes this, then we'll put it on the buy, or if it goes the other way, it will be a sell? Or is there some kind of discretionary overlay in it where you sort of take your fundamental view, consensus feelings, or something else in to put it to a specific recommendation, on energy or gold or whatever it might be?
It's a very important question. I'm glad you asked. It's a very important question. At the end of the day, what is the essence of AI? The essence of AI, essentially, you have logistical regressions, looked at many circles and configure it. Essentially, they make probabilistic inferences. That's what we do, right? So we make probabilistic inferences when the setup is favorable. Of course, there is a lot of noise, and markets are obviously very noisy one way or another. It happens all the time. So the idea is actually, the answer is probabilistic, right? When we have a certain threshold achieved, like do you want a probability of 75% or 85%, then it says buy or sell. Yeah. But there is more to your question, Morgan's, which is a wonderful question. In life and in statistics, and then especially, obviously it applies to financial markets, there is inevitable trade-off between early detection or the certainty of detection. You're never quite sure if you're walking up the mountains where exactly the mountain starts. right? I mean, like there's a technical beginning of a mountain, but like every like feet up is at the beginning of the mountain, or when you're only 100 meters up or half a mile up. What defines a mountain, right? So making a judgment when you already had 100 feet up or like 2 kilometers up, then you can play, hey, I'm definitely on the mountain, right? This is actually where there is always a trade-off between certainty and early detection. So this inevitable trade-off, it comes from physics signal detection, right? Where you make a subjective assessment like, hey, 75% is enough, or 85, because you can be 100% right on any forecast. But in doing so, you'll miss a lot of important things.
True.
So you can be 100% right, but you will be almost always too late. So it's a balance of accepting reasonable amount of uncertainty and yet saying, hey, looks very plausible. So that's actually one of the parameters that our clients can optimize and input. Say they want a high threshold or low threshold, high conviction signals, low conviction signals. Again, the trade-off, typically, the more you want a certainty, the more you're likely to exclude early warnings. Interesting. Go ahead.
One of the questions coming in is if you can also predict, for instance, any macroeconomics, for instance, the CPI in the US, if your AI system can do that.
The short answer is yes and no. We do that, and I'll show you a couple of examples. But ironically, forecasting macro indicators is easier and ironically less relevant, because the tricky part is not only to predict a macroeconomic indicator, but also to predict how the markets will react to that. So when you're imposing, say, let's assume you're 70% right on macro prediction. And then based on that, you think if, say, GDP will be a little slow, that will probably, interest rates will drop. That also has an element of uncertainty. And let's assume you're 70% on both of them. 70% multiplied by 70%, assuming not exactly correctly, independence brings you down to 49%. 70.7 multiplied by 0.7. So essentially, we made a decision at the very beginning that we forecast the markets, not macro, because it's more important and ironically more accurate. Yes, again, we can do forecast macroeconomic indicators, but ironically, that's what conventional people do. And even more importantly, philosophically, we believe that market leads, news lag. Most people in the investment world, they think that once you lay out all the facts, you can forecast the future. Well, we think the future is shaping by so many facts, you cannot lay them up. And again, people will say, hey, in order to forecast GDP, I need to know interest rates and commodities and so on, right? Well, these are interconnected, right? I would rather forecast, it's easy to forecast GDP from interest rates than the other way around. Here's an example, and this is a factual historical example, when we had a sell on the S&P 500 6 weeks before the COVID shutdowns. That was a dramatic, really dramatic example. When we were able to forecast seemingly unexpected, truly unprecedented sell-off in S&P from that was February 4th, February 5th, approximately. Again, governments, as you remember, the timeline was like early February, people were talking about some virus in China, and people were like, oh, it's like will not happen in America or in Europe. Like then there was some news in Italy, and the markets were already selling off. And then end of March, like 50s or 20s, government started imposing lockdowns. Germany and the rest of Europe and so on, right? And Canada, of course, and US and so on. But the market was already kind of like at the bottom. So the market was already there before they shut down the economy. And then the economy has rallied. Not because of the stimulus and so on. Again, we didn't know that it will happen, but we had this view, we had actually our tools detecting outflows from S&P into safe happens back then. I will not go through all the details. For those who are interested, we can explain that later, and our clients know that. So there is a great predictive power in money rotations.
Okay.
So this is exactly a dramatic example when forecasting macroeconomic events would have been useless because COVID never happened before, in a classic sense. Not in a classic sense where we had the Spanish flu and so on, but it has never really happened as broadly, as painfully, and as tragically as unfortunately it did. Yet again, we were focused on the markets, and at this point we were buying bonds and we were selling risk. That was a very, very helpful insight to our clients. Since we are speaking of the news of this morning, and since I stated on the high level, let me show you how we help with maybe single name stocks, because a lot of our probably users actually do traffic in single name stocks. So I went to the industrials page, and what we do here, we have and I selected a bunch of European stocks and European automakers and US automakers. So what we have here, we have a series of cells on thematic cells on Ford and General Motors and Tesla and Mercedes and Valeo and BMW. And I knew it was a theme, and I noticed those were accurate cells. And even this morning, there were some news out of Europe stating that our European, I think it's in the UK, they was launching some sort of Dieselgate, some investigation into car manufacturers. So again, we didn't know that there will be some investigation, but in general, our tools concluded that this stocks as automakers, like we see it definitely in the European side, Mercedes, we sold it close to the top. We had a sell on Mercedes at similarly this area, and you saw like BMW and so on. So this is actually sometimes you can so explain the news as they unfold through our tools, which saw those kind of like risk reward was not there. So that's another example when our tools were bailing out of automakers because our flows were abating. So these money flows do have predictive power.
So I just noticed Stellantis, for several reasons. I have an interest in that one, but there you have a short recommendation. So I presume the difference is that you're now saying even if you don't hold the stock, sell it anyway, kind of message. Is that something that's also built into your system? And when do you move from, I mean, I would assume that short is a more aggressive recommendation than a sell.
Correct.
That you're sort of opening up a wide exposure, shorts can really get hurt. So what's the difference? How do you decide that it's a short, not just a sell?
Shorting is a different game, and hopefully we're not insulting anyone, any holders of Stellantis. We're suggesting to short. It's very objective and very unbiased exercise, right? So the difference between a sell and a short reflects the fundamental and mathematical nuances. So typically sell means a hold. So you kind of sell it. You go to zero, or at least you don't buy anymore. So it's kind of avoid position, right? So not interesting. It might still go up. Like we had a sell on GM, and despite other automakers, it actually went up. That's fine. We just didn't see a risk reward being favorable enough. We just thought like, okay, that's kind of like, we see a better place elsewhere. Fine. But the short is actually the one where you see conviction to the downside, where you definitely want out of this position. And you see this clear asymmetric downside. And additionally, as a short, if you use like a short, obviously means it has to mean it's short in nature, like that doesn't last long, and also short meaning lack of thereof. So that's what it means. Like, so like technically came from that short signals also tend to be short in nature, right? So they don't last too long, which reflects reality. Most of the time, most of the stocks go up, or they pay dividends, or some corporate actions emerge, and so on, right? So that's usually the difference between stylistic difference between longs and shorts. But some of our clients do short, and they consult our tools in order to have that important distinction. And thank you for that question, Morgan, again.
No worries.
Speaking, I mentioned briefly that, as we all know, and especially in many professional investors are not excited about that the market remains very narrow. So we're still dominated by the technology around. So NVIDIA's and Google's and Microsoft's and Apple's are still having around. They still have this dominance. And for better or worse, again, I personally don't like it that the market is dominated by very, very, very few mega cap stocks. I'm much more pro-democratic, and we like them. So again, they're expensive. They are all everybody owns Apple and Google and Microsoft and of course NVIDIA. Yet we see that money flows, and we still the upside to this is actually index of big technology stocks XLK, which is representative, and it's all dominated by those big names that I have mentioned. Right. So again, the idea we don't fight the global the big trends. We just see it when it turns, and we help you to be on the right side of the market. And when we do that, I'll give you another example of unexpected rotations. I'll bring up the big stock, Apple, of course. And here is Apple. I will turn our short-term mixed signals. And this is actually, interestingly enough, that was right at the day before Apple has reported earnings. Earnings were pretty soft. They were declining revenue, but the stock wanted to rally regardless, and it rallied, and we captured that run. That was a good gain for our clients. And again, it's an example of like when the Apple rallied 20%, not because the story was good. No. They're just buying back shares, and it's okay. And the people were rotating it to their safety of the quality big market caps. That's it. So fundamentally, nobody can justify why Apple, and it was expensive, and it is expensive, and it's big, rallied. But that was not our argument. We saw it heading higher, and it was a good call. So that's another example when something not obvious still worked because money flows were happening there. So we have a lot of things happening in the world, and we forecast pretty much anything and everything. We forecast all the markets and emerging markets, all the stocks in emerging markets and in Europe. And unfortunately, it pains me to say that despite us having right now, and mortgage obviously sits in Denmark, we have a fairly bearish view on Europe. We like European bonds, but we think European equities had a run. So we had a sell on Euro 600 probably. We have sells on many key constituencies. We have sell and short on. We're selling France. We're selling Italy, and so on. So essentially in Europe, those were decent calls. Again, sells are not really shorts. So we underweight Europe. Maybe because one of the major drivers of the run-up in European shares were European banks. So European banks did really well. And by the way, Italy was the single best performing, I think it was number 2 last year in US dollars. But now has run its course. And we think it's time to trim your exposure to European banks. And obviously, many European indexes have heavy into banks and insurance companies, including, of course, for such countries as Italy and Spain and France, where a great deal of index holdings is dominated by the local banks. So that's what we're cooling off. Some people might try to relate that to the interest rates dynamics. Maybe low interest rates are bad for European banks. Maybe that's part of an answer, but there is something more to that. Maybe it has a fully reached evaluation, or maybe just people rotating to something else. We don't fully know, but we know that is happening. So pace of inflows as depicted by those arrows into European banks and in many European equities is slowing down.
So in the interest of time, Konstantin, because we're already running on 40 minutes, and I have a strong feeling you could go on for another 40, but I'm not sure we can keep the audience that long. I have one question from one of our viewers here that says, what's the typical time horizon when you put a recommendation on? Should we think about it as in the span of up to 3 months, or half a year, or a year, or is that actually something as a client you yourself can choose what kind of time parameter we should be looking out to? Because some people are maybe slightly shorter term in their mindsets, and others are maybe more, well, let's buy it now and then let's take another look in 6-12 months and see how it goes. Not sure that many left of that type of investors, but
it's an important question. It's a very, very important question, aligning the directionality of the so simplistically speaking, we don't impose any horizons on forecasting. So we just read them objectively and let it last as long as possible. We think that imposing artificially constraints, like I want to be, say, either short-term or long-term, we don't do that. However, empirically, we do found that on average, our horizon lasts about, on average, 5 to 6 months, on average. However, recently we rolled out, in addition to our tools, where we added short-term signals so this is, again, I will be plotting bonds inversely. So I will be where we added tactical signals where we're able to go to 2 or 3 weeks for those people who want to be extra sensitive on timing, who don't want, or who just active traders. So we have essentially right now 2 horizons, 4 to 6 months, or say 3 weeks. So essentially we were able to delineate the horizons using those 2 timelines.
Okay. So we've been around a lot of areas, a lot of talks, but not only about how you set up the system, how you derive your signals, how you take money flows, and you have some estimations about where they go from and where they go to, and how people can use your engine, for lack of a better word, in all asset classes really, and in different time horizons. And one last question for me would be, because you talk a lot about dollars or euros. So if I'm a dollar investor or I'm a euro investor, from my sort of basic point, is that something you also put on the engine? And I can say, well, I'm a euro investor, so I want everything viewed from a euro perspective, and someone else is a yen investor and they would want to look at it from a yen perspective.
The short answer is yes. So we do offer customized watch list where ideas will be aligned for your interests, and we can do currency translations from different angles, including those selective pairs. So the short answer is yes, and it's a good question.
Good.
But for the most part, we would be able to achieve 70 or 80% of that.
Yeah.
Okay.
So I think if there are no more questions from the audience and nothing that you really want to talk more about right now, we are closing in on 45 minutes. I think it's a good time to maybe stop now. I know we talked in the past that we're going to do much more of these type of webinars together. So also for anyone who's watching, if you want more specific detailed issues discovered in the next webinar, please send an email to me or to Konstantin, and we will prepare that into the next round.
Thank you very much indeed.
Thank you very much, everybody. We will stop here in a few hours. I think it will be ready on the replay, which you should get automatically. And if you don't, please also again reach out to us, and we'll get it to you.
Thank you again, Morgan, for setting things up, and we appreciate everyone's interest and everyone's time. And